Beginner's Guide to Investing in Real Estate. Real estate can oftentimes prove to be a lucrative investment, offering income in the form of rent and capital appreciation if you sell property at a profit. It's also a great way to diversify your portfolio with an asset that's influenced differently than traditional stocks and bonds. Real estate investments are more accessible than ever before to the everyday individual. Here are 5 ways to get started. Becoming a landlord. This is probably the most classic way to invest in real estate. The goal is to buy a single or multi-unit dwelling, rent it out, and generate income from the rents if the overhead is low. This can provide a steady stream of tax-efficient income, and property can always be sold in the future if liquidity needs arise. Pros: direct control over the property, property appreciation, and tax-efficient income. Cons: tenant issues are likely to arise, things like non-payment, late payments, etc. Property vacancy. Property management or maintenance might be required. So similar to buying a home, you can flip a home, a strategy where you buy a property, oftentimes a distressed property, fix it up and sell it for a higher price after making improvements. The pros are fast return on investment, control over the potential increase of the property value, you can be repeated with relatively ease. Cons: unforeseen costs, labor intensive, and illiquidity for a period of time. Now, another way of owning real estate without actually buying a property is to buy a REIT. A real estate investment trust is a company that owns and/or operates income-producing real estate. Oftentimes, these companies own a portfolio of various types of real estate investment holdings, such as office space, multifamily, apartment complexes, healthcare facilities, or shopping centers. Individuals can easily access REITs through a mutual fund or ETF offering. Investors purchase shares of a REIT and they earn a proportionate share of the income produced by those assets. The pros are access to real estate investment without owning or operating the property. There's low barrier to entry and minimum investment requirements. There's some uncorrelation with the stock market, and these are traded on public exchanges. The cons are no control over the property. There's a loss of tax benefits related to personal ownership. It carries fees and expenses to be aware of. Now, similar to REITs are RELPs, real estate limited partnerships. These are similar in the sense that they provide investors with a diversified portfolio of real estate investments, but they are primarily a form of private equity and not traded on the public exchanges. Instead, they set a term. Like a small company, these groups identify properties to purchase and/or develop, manage, and eventually sell off with the profits distributed along the way. When all of the holdings are sold off, the partnership dissolves. The pros of this are passive income with no decision-making or day-to-day maintenance required. The income and losses pass through to the individual investors, including the deductions for depreciation and mortgage interest. It reduces legal liability, and you can partner with a general partner that has extensive experience investing or managing real estate. The cons are very limited control over the investment, could be illiquid for a potentially long period of time, and it relies on the integrity and expertise of the general partner for success. Another strategy that's become more popular in recent years is crowdfunding. This is a strategy that allows investors to band together to raise capital, typically online, to buy real estate properties or fund development projects. There are numerous online platforms today that allow the individual investor to get started. The pros are low cost access, passive income. Oftentimes, real estate deals are professionally vetted. There's potential access to commercial properties, not just the residential. The cons would be periods of illiquidity, loss of tax benefits that come with personal ownership, and it carries fees and expenses. Now, one of the biggest perks of real estate investments are the tax benefits. You get the deduction on expenses. The IRS allows you to deduct expenses directly related to the operation, management, and maintenance of the property. You can also write off what you pay to run your real estate investment business. These are called qualified business expenses. Depreciation. You get to deduct the incremental loss of an asset's value over time, generally due to wear and tear. This will lower your taxable income and possibly reduce tax liability. Another benefit is pass-through deductions. When you own real estate as a sole proprietor in a partnership or through an LLC or S corporation, you can deduct up to 20% of your QBI or qualified business income on your personal taxes. Capital gains taxes are probably one of the biggest benefits. When you sell the asset at a profit, so long as you've held the asset or property for longer than 1 year, you get to pay long-term capital gains tax rates. These types of gains have a significantly lower tax rate than ordinary income. Real estate allows you to avoid FICA. Investors are not required to pay FICA tax, otherwise known as Social Security and Medicare taxes. Investing in real estate is one way to generate passive income and long-term property appreciation. It can be a hedge against stock market volatility, and there are a variety of options available today so anyone can get started. Keep in mind that real estate in general is a relatively illiquid asset. It can take a while for the investment to pay off, so it's better to think of it as a long-term investment. If you would like help in determining how real estate can play a role in your overall financial plan, contact Pure Financial for a free financial assessment.